Welcome to Rombuxland Podcast. I'm your host, and this is episode 11. Today, we're going to talk about cryptocurrency market analysis, a topic that's really hot right now. A lot of people are interested in investing in cryptocurrencies, but they don't know how to get started or what to look out for. As your host, I'll try to break it down in a way that's easy to understand, even if you're new to the world of cryptocurrencies. First, let's start with the basics. What is cryptocurrency anyway? Well, cryptocurrency is a digital or virtual currency that uses cryptography for security. It's decentralized, which means that it's not controlled by any government or central bank. Bitcoin is one of the most well-known cryptocurrencies, but there are many others, like Ethereum, Litecoin, and Monero, to name a few. Now let's talk about the blockchain. The blockchain is the underlying technology that makes cryptocurrencies possible. It's a public ledger that records all transactions made with a particular cryptocurrency. The blockchain is maintained by a network of computers around the world, which makes it virtually impossible to hack or manipulate. As we all know, the cryptocurrency is highly volatile, which means that the prices can go up and down quickly. This can be both good and bad. On the one hand, it means that there's a lot of potential for profit. But on the other hand, it also means that there's a lot of risk involved. So, how do you analyze the cryptocurrency market? Well, there are several factors to look at. First, you need to understand the overall market trends. Are the prices going up or down? Are there any major events that could affect the market? Second, you need to look at the individual cryptocurrencies themselves. What's their market capitalization? Are they growing or shrinking? Third, you need to consider the overall economic conditions. Is the economy growing or shrinking? Are there any major events that could affect the market? Let's take a look at some examples. For instance, in 2017, Bitcoin's price skyrocketed from around $1,000 to over $19,000 in just a few months. This was largely due to the increasing adoption of Bitcoin by institutions and individuals alike. However, the price then dropped down to around $3,000 in just a few months. Another example is Ethereum. In 2018, Ethereum's price dropped to around $300 due to a major hack that affected one of its exchanges. However, the price then rebounded to over $1,000 in just a few months. As you can see, the cryptocurrency market can be highly unpredictable, and there are many factors that can affect the prices. However, this also means that there's a lot of potential for profit. Now let's talk about some of the investment strategies that you can use when it comes to cryptocurrencies. One strategy is to invest in a diversified portfolio of cryptocurrencies. This means that you invest in a variety of different cryptocurrencies in order to spread out the risk. Another strategy is to invest in a specific cryptocurrency that you believe has a lot of potential. For example, you could invest in a cryptocurrency that's just starting to gain traction. Another strategy is to use dollar cost averaging. This means that you invest a fixed amount of money at regular intervals, regardless of the market conditions. This can help to reduce the risk of investing in cryptocurrencies. One of the key things to remember when it comes to investing in cryptocurrencies is to never put all of your eggs in one basket. This means that you should always diversify your portfolio and not invest more than you can afford to lose. Now, let's talk about some of the risks involved with investing in cryptocurrencies. One of the biggest risks is that the prices can go down quickly. If you invest all of your money in a particular cryptocurrency and the price drops down, then you could lose a lot of money. Another risk is that the cryptocurrency market can be highly manipulated. This means that large investors can buy and sell cryptocurrencies in order to affect the prices. Also to these risks, there are also other risks to consider, such as the risk of hacking and the risk of regulatory changes. For example, if a government were to ban a particular cryptocurrency, then the price could drop significantly. However, despite these risks, many people are still investing in cryptocurrencies, and for good reason. Cryptocurrencies offer a lot of potential for profit, and they can also provide a way for people to store value and make transactions without the need for intermediaries like banks. So, how can you get started with investing in cryptocurrencies? Well, first, you need to do your own research and learn as much as you can about the market and the different cryptocurrencies. Second, you need to set up a digital wallet in order to store your cryptocurrencies. Finally, you need to invest in a reputable exchange in order to buy and sell your cryptocurrencies. Now, I want to share with you 2 detailed case studies that show the potential of investing in cryptocurrencies. The first case study is about a person who invested $1,000 in Bitcoin in 2017 and held on to it for a year. By the end of the year, the investment had grown to over $20,000. This is a return of over 1,900% in just 1 year. Here's a breakdown of the case study. In 2017, the person invested $1,000 in Bitcoin, which was around $1,000 at the time. The person then held on to the investment for a year, and by the end of 2018, the price of Bitcoin had skyrocketed to over $19,000. The person's initial investment of $1,000 had grown to over $20,000, which is a return of over 1,900%. The second case study is about a person who invested $5,000 in Ethereum in 2018 and held on to it for 6 months. By the end of the 6 months, the investment had grown to over $15,000. This is a return of over 200% in just 6 months. Here's a breakdown of the case study. In 2018, the person invested $5,000 in Ethereum, which was around $500 at the time. The person then held on to the investment for 6 months, and by the end of 2018, the price of Ethereum had rebounded to over $1,000. The person's initial investment of $5,000 had grown to over $15,000, which is a return of over 200%. As you can see, these case studies show the potential of investing in cryptocurrencies. However, they also show the risks involved, and it's essential to remember that past performance is not a guarantee of future results. Let's talk about some expert quotes and industry insights that can help you to understand the cryptocurrency market better. One expert is a well-known cryptocurrency analyst who says, "The cryptocurrency market is a highly volatile market, and it's essential to be aware of the risks involved. However, with the right strategies and a good understanding of the market, you can make informed investment decisions." Now consider this. Another expert is a cryptocurrency investor who says, "I've been investing in cryptocurrencies for several years. I've seen the market go up and down. However, I believe that the potential for profit in the cryptocurrency market is still huge. I'm continuing to invest in it." Now, let's talk about some future predictions and trends that you should be aware of. One trend is the increasing adoption of cryptocurrencies by institutions and individuals alike. This means that more and more people will be investing in cryptocurrencies, which could lead to higher prices. Another trend is the development of new technologies that can improve the security and efficiency of cryptocurrencies. This could lead to more widespread adoption of cryptocurrencies and higher prices. Before we wrap up, let's answer some of the common questions that our listeners may have. What's the best way to get started with investing in cryptocurrencies? Well, first, you need to do your own research and learn as much as you can about the market and the different cryptocurrencies. Second, you need to set up a digital wallet in order to store your cryptocurrencies. Finally, you need to invest in a reputable exchange in order to buy and sell your cryptocurrencies. What's the difference between a cryptocurrency and a blockchain? Well, a cryptocurrency is a digital or virtual currency that uses cryptography for security, while a blockchain is the underlying technology that makes cryptocurrencies possible. It's a public ledger that records all transactions made with a particular cryptocurrency. Can you give us some tips on how to stay safe while investing in cryptocurrencies? Well, first, you need to be aware of the risks involved. Second, you need to do your own research and never invest more than you can afford to lose. Finally, you need to keep your personal and financial information secure. Now, let's go over a step-by-step implementation guide for investing in cryptocurrencies. First, you need to do your own research and learn as much as you can about the market and the different cryptocurrencies. Second, you need to set up a digital wallet in order to store your cryptocurrencies. Third, you need to invest in a reputable exchange in order to buy and sell your cryptocurrencies. Fourth, you need to diversify your portfolio by investing in a variety of different cryptocurrencies. Fifth, you need to set up price alerts and stay informed about the market trends. Here's a more detailed step-by-step guide. Now consider this. Step 1. Do your own research and learn as much as you can about the market and the different cryptocurrencies. This will help you to understand the risks and potential rewards of investing in cryptocurrencies. Step 2. Set up a digital wallet in order to store your cryptocurrencies. This will help you to keep your cryptocurrencies safe and secure. Step 3. Invest in a reputable exchange in order to buy and sell your cryptocurrencies. This will give you access to a wide range of cryptocurrencies and allow you to trade them easily. Step 4. Diversify your portfolio by investing in a variety of different cryptocurrencies. This will help to reduce the risk of investing in cryptocurrencies and increase your potential returns. Step 5. Set up price alerts and stay informed about the market trends. This will help you to stay ahead of the curve and make informed investment decisions. Step 6. Monitor your investments regularly and adjust your strategy as needed. This will help you to stay on track and achieve your investment goals. Step 7. Consider using dollar-cost averaging to reduce the risk of investing in cryptocurrencies. This involves investing a fixed amount of money at regular intervals, regardless of the market conditions. Step 8. Consider using a cryptocurrency investment portfolio to diversify your investments and reduce risk. This can help you to spread your risk across a variety of different cryptocurrencies and increase your potential returns. Step 9. Consider using a cryptocurrency trading bot to automate your trades and reduce the risk of human error. This can help you to stay ahead of the curve and make informed investment decisions. Step 10. Consider seeking advice from a financial advisor or investment expert to help you to make informed investment decisions. This can help you to stay on track and achieve your investment goals. Thank you for tuning in to this episode of Rombuxland Podcast. If you have any questions or comments, please don't hesitate to reach out. We'll be back with more episodes soon. As we wrap up this episode, I want to leave you with some final thoughts. Investing in cryptocurrencies can be a great way to diversify your portfolio and potentially earn high returns. However, it's essential to remember that the cryptocurrency market is highly volatile, and there are many risks involved. If you're new to the world of cryptocurrencies, I encourage you to do your own research and learn as much as you can about the market and the different cryptocurrencies. Don't be afraid to ask questions and seek advice from experts. And always remember to never put all of your eggs in one basket and to always diversify your portfolio. I also want to leave you with some parting words of wisdom from a well-known cryptocurrency investor. He says, "The key to successful investing in cryptocurrencies is to be patient and stay informed. Don't get caught up in the hype and always remember to do your own research. With the right strategy and a good understanding of the market, you can make informed investment decisions and achieve your investment goals." Now consider this. Thank you again for tuning into this episode of Rombuxland Podcast. We'll be back with more episodes soon, and I'll see you in the next one.